Steve, thanks so much for being back on Wall Street Week.
Of course, love to be here.
So you wrote a terrific op-ed piece for the New York Times this week, in which you said, and these are pretty strong words, I must say, you think that this may be one of the best packages that you can remember Congress giving birth to. So you think this is a good idea for the country. What does it mean for investors?
I think for investors, it's basically positive. I think we're making progress on a number of our really important problems, climate being first and foremost among them. That's good for the country. It's ultimately good for investors. I think prescription drugs pricing may not be absolutely great for every pharma company in America, but for the average American, it will eventually give them more spending power and therefore the ability to buy other things, and that helps the economy. The minimum corporate tax is just something we needed to do. I think the Trump TCJA was so wildly unfair in terms of the amount of the business rollbacks that this brought back. I would note that after the Manchin proposal was very surprisingly announced, as you know, nobody thought this was coming, but after it was announced, the stock market in the next several days had several of its best days throughout the difficult period. So obviously investors were not put off by this thing, and indeed even encouraged by the idea of progress in Washington.
One of the things Republicans have picked on, for example, Pat Toomey from Pennsylvania, is to say that corporate minimum tax effectively would take some of the benefits away from the expensing of capital investment, will deter capital investment by corporations, ultimately hurt us in terms of investment and in terms of growth.
Well, the first part of that is right. We are taking some incentives away. Although we're doing it, we're not really directly taking them away. We didn't roll back the depreciation provision. We simply put a minimum tax on all of the corporate profits. So that, in fact, leaves most of the investment incentive in place. But there are those of us who felt that that was simply too much when it was passed, the TCJA. Why give companies 100% write-off up front? Is that really going to change investment that much? Is it really the way you want to run tax policy? And I don't think there's a lot of evidence that had much of an impact on investment. So I don't buy that. I think the problem of investment here is there are not enough profitable opportunities out there, not that companies are worried about their tax rate or they don't have the cash or something like that.
One of the aspects of this, obviously, is the inflation reduction because, as I understand it, of reducing the deficit, actually paying for it, having more in revenue than the costs going out. What does that do to investors?
Well, first, on the inflation thing, the Republicans have created, I think, a false dichotomy in a way. They've made the point or claimed this wouldn't really reduce inflation. And that's not untrue. Its impact on inflation in the first few years is relatively small, gets a bit larger in the out years. But the most important thing is that it is a reversal of policy from the last several packages we've passed that have been highly inflationary. So I think this is good for investors in that it brings, again, some stability to fiscal policy in Washington. For the first time in a long time, a fiscal policy package that actually does at least lean against inflation, even if the total impact isn't enormous.
If this package, and again, we're assuming for the moment that it gets enacted, if it in fact gets enacted, is the benefit to investors mainly sort of the rising tide notion? I mean, it's the macro that everything goes up and so we're all better off, or are there specific sectors that actually would be more attractive to investors, such as you mentioned, climate and energy?
But yes, the rising tide is certainly the overarching part of this. It's not a complicated package. It doesn't have that many provisions in it. So it really is climate and prescription drugs, and then obviously some of the tax stuff. So in climate, I don't think anyone yet has really been able to comb through all the little minutia in this bill. But in the climate section, you have to believe there will be opportunities for investors and also warning signs for investors about where not to invest as we go through this energy transition. And then we'll have to get a better understanding on the pharma side of what the impact is on that sector. But that's a long phased-in program over, I think, 7 or 8 years. And so, again, no immediate impact.
You manage investments around the world, not just in the United States. One of the key questions we always ask is, what does this do to the competitiveness of the United States versus other regions, whether it's China, Europe, wherever? Does this make the United States more competitive in success?
I'm not sure the difference is that great. I think that this is an important bill for the reasons that I wrote in my piece and the reasons I believe. But I'm not going to sit here and pretend it's going to transform everything. I think with respect to climate, for example, it simply gets us closer to meeting the Paris Accord. Look, we have to understand that addressing the climate problem costs us money. People who say, well, you can kind of make this a profit center. It's not a profit center. It's a cost center. It's something. It's an externality, as economists would say, a byproduct of our having been irresponsible for many years, and now we're going to pay the price of cleaning it up. So I would not pretend it makes us more competitive. I would say that it gets us more in line with some of our partners, particularly in Europe, who've done more on climate than we have, and it's time for us to do our share.
Is addressing the climate situation inherently inflationary?
Inherently, there's a cost to it. Look, I believe, and I'm sure some economists have studied this, but if you go back to the early 70s when we had a huge environmental problem, and you and I are old enough to remember when the Cuyahoga River went on fire, and that sort of galvanized people to do something, part of, I think, why our economy struggled in those years was because we were paying a huge cost to clean up environmental problems all over this country that were cost but not revenues, cost but not profits, cost but not really benefits beyond having a better environment. And I don't think this is as big a deal as that, but this is in the same direction. There is a cost to addressing climate, and we shouldn't pretend it's otherwise.
It's part of a larger pattern that we're addressing right now of inflation. And just while I have you, let's talk about that issue as an investor. Because there's a back and forth. Is the Fed going to go too far? Are they not going to go far enough? The markets are reacting, perhaps overreacting to some of the hints we're seeing right now. How does the Fed raising rates affect you? I mean, are you happy with them raising rates? Do you want them to do more, less? What's best for you as an investor, a long-term investor, I should say?
Sure. Well, look, first of all, markets are not always right. And as we sit here today, markets are assuming a path for the Fed and a path for the economy that many of us feel is completely unrealistic. And if anything, the markets have gotten more optimistic about how far the Fed will have to go, when rates will come down over the last several weeks. You've seen the 10-year come down. You've seen the 5-year forwards. You know, all the indicators are that the markets have become, I think, irrationally optimistic about what the Fed is going to have to do. High rates are the enemy of the stock market. There is no getting around it. It is the alternative use of capital. It's the so-called risk premium. You know all that. And so I have been fairly bearish on the market because rates have to go up. And I would continue to take that posture. I think rates are going to have to continue to go up very substantially. I think we have a kind of embedded core rate of inflation, if you will, of between 4% and 5% in this economy. So it's not 9%, but it's still so far above the Fed's 2%. They're going to have to do a lot of work to get it back there.